Hello, this is part 2 of our section on banks and credit unions. And previously we've talked really about the difference between banks and credit unions. And then today we're going to talk about the differences between accounts, like a checking account, a savings account, that type of thing. Okay, let's get started. Let's start with a checking account. Most people have a checking account. This is an account that is specifically designed to write checks on or have a debit card. So typically in a checking account, you're going to have a lot of transactions in and out, right? You'll get your pay stub, your direct deposit from, and your pay stub is your receipt, but your direct deposit coming in, and then you're going to have some transactions, whether it be through monthly bills or whatever it is. Okay, so there's going to be a lot of transactions in a checking account, usually a very low interest rate that the credit union pays you. Banks usually charge you money for this, but we've talked before about credit unions being a lot better than banks. Okay. Savings account, this is primarily kind of what it sounds like. I mean, the account is designed so that you can save money. Okay, so they usually pay you a higher yield. You get more interest for your money because there's a lot less transactions. So there's a lot less to keep track of. You know, in a checking account, you might have 50 or 60 transactions in a month. In a savings account, you might have, 5, 3. I mean, usually you're just putting money in to save. Like that's what a lot of people do for Christmas. They just save money every paycheck that they get to pay for Christmas. So anyway, so that's a savings account. A debit card. Well, we've kind of shown a picture before, and it looks just like a credit card. The only difference is that when you swipe that one or when you plug it in, depending if it's a chip card, the money comes directly out of your checking account. Okay, so there's no lag time. You're not borrowing the money and then paying it back at a later date. The money will come directly out of your checking account. Right then, okay? And it's good. There's nothing wrong with the debit card. Again, I do counsel you to pay cash for as many things as you possibly can, but there are a couple things that you have to have a debit card for, like when you rent a hotel, when you rent a car, they need to have a debit card or something there that's more than just cash. So anyway, so that's a debit card. Money market account. Money market account is kind of in between a checking account and a savings account. Okay, a lot less transactions, maybe not as many and not as few as a checking account, but a lot less than a checking account. So it's kind of in between those two. They pay a little bit higher interest rate than a checking account, and usually put like a lot of money in there. This is where you'll put money like as you're setting money aside to invest, but you're not ready to invest it yet. You'll stick it into like a money market account. Money market accounts are good. All money market, checking, savings, those are all good accounts. There's nothing wrong with any of those. So let's talk about the automated teller. Okay, so this is ATM machines, right? You're familiar with what an ATM machine is. You put in your debit card or bank card and then your code, and you can pull money out of your account. Not a bad way to do it. When they first came out, just a little bit of gossip, if you will, when they first came out, the people thought they were going to take away the bank tellers' jobs. So what they did is the bank tellers would refer to them as the ugly teller, like the bank teller was the beautiful one. That's the one you wanted to come in and see. Well, anyway, so that's what they referred to them was the ugly teller, and to this day, my parents still refer to them as the ugly teller. Can you go get money out of the ugly teller? Anyway, just fun fact. Anyway, but they do charge money. A lot of banks charge money to use the ATM, so just be aware of that. I prefer to walk in and talk to the people at my credit union just face-to-face. That's very easy. It doesn't cost me anything, and I get that human interaction, and I make sure that I get my increments the way I want them because sometimes I need 5s and 10s and 20s and 100s, so this way I can get them exactly like where I want them. But when you go to an ATM, it's usually just 20s. Sometimes there are 50s. But so just plan ahead. I would recommend that you don't use ATMs that often. And if you do, make sure it's at your bank so they don't charge you extra money for it. Let's talk about just kind of in general what it costs for the services. When you go into a bank or credit union and you pull money out or you deposit money, on average, that bank is spending $1 per transaction, okay? Because they got to pay the employee, they have to pay for the utilities, they have to pay for rent, that kind of thing. So it's not cheap, so $1. Now, this is why they like ATMs, because with an ATM, it only costs them 30 cents. So they just saved 70% if they can convince you to go to the ATM. So that's why a lot of them try to do that. Well, let's talk about online. Pretty much everyone's going online, and right now, almost every bank and credit union is coming out with a mobile app because it costs so little in comparison. 1 penny is all it costs for the transaction. Instead of paying $1, you lowered your cost by 99%. That's why they push that a lot. And it's very convenient because if it's at midnight, I can transfer money from my savings to my checking, whatever the case may be. So it's very convenient. I like it. Okay, a CD. A CD, whenever I got my degree in finance, we always refer to CDs as certificates of depreciation. So they're not good investment vehicles. What it basically does is you take and you put your money in there, and they're going to pay you a little bit higher than the normal savings account interest, with the understanding and the agreement that you will keep the money in there for a given period of time. For instance, like a 2-year CD, that means you have to take your money, you have to put it in there, and you can't touch it for 2 years. Then the bank can take and lend out your money to someone else. That's how they make their profits. So they're guaranteed to have that money there for 2 years, and they're going to pay a little bit higher interest rate. For instance, if a savings account is paying you, let's say 1%, a CD might pay you 3%. So you're getting a little bit higher interest rate, but you can't touch your money, and it doesn't grow any more than that 3%. So this is not a good investment vehicle. The only time, let's see, I don't think I've ever done a CD. But the only time I can think of that it would be beneficial for someone to do a CD is like, let's say you sold your house and the proceeds from the house were $100,000, and you're buying your new house. It's being built, so it's going to take 6 months to build. So the time between you sold your old house and you move into your new house is 6 months. So in that time period there, you don't want to invest in the stock market, right? We don't want to invest in the stock market unless we've got it in there for about 3 years at least. So what are you going to do with your money? You're going to put it in your savings account? Well, okay, that pays you 1%. Or if you put it into a CD, it pays you at least 3%. So you get more interest off it. That would be a reasonable method to use for putting your money. But other than that, it's not an investment. Do not put your money there. There's so many other vehicles that you can pay a lot higher interest that I would not put my money in there. So anyway, that's a CD. Treasury bill. Okay, this is an important one. So this is when we talk about the debt that the federal government has, it is in T-bills. Okay, so on your treasury bill, you can actually loan the government money, and they will pay you an interest rate. And the interest rate fluctuates a little bit depending on how long the term is. Right now, they're really, really inexpensive. But here's the thing you got to know. The history of our nation, the number of times that we've defaulted on our debt is 0. 0, 0, 0. So the likelihood that you're going to get that money back is pretty high, right? I mean, it hasn't happened yet, and I don't foresee it happening in the future. And part of the reason is, well, if we owe more money, can't we just hit print on the printer and print off some more money? I mean, it's not backed by gold. There's no backing, so they just print off more money, and then they can pay their debt all of a sudden, right? I mean, that would cause inflation, of course. But we see that happening quite a bit. You know, it's happened under different presidencies. And so what you need to understand with the T-bill is it's a very safe investment. In fact, it's considered the very safest investment on earth. So, for instance, let's say that the T-bills were paying 5% interest, and your buddy's starting a new business. And he says, hey, if you give me $1,000, I will pay you 6% interest. And you go, well, so I'm going to give you on the startups money so you can pay me 6% interest when the safest investment on earth is paying me 5%? No thanks. I'm going to go to the 5% and I'm guaranteed to get my money, right? It doesn't make sense. So you want to always kind of compare it against that. For instance, historically, our T-bills have been, they range. They do range quite a bit, but you might get 3%. You might get 6% on a T-bill. So they pay some interest, but stocks averaging 11%, I'm going to take the stocks every time. I mean, that's double the amount of return. Yes, I have more ups and downs and some fluctuation, and I risk potentially losing some money, but over the long haul, it pays so much more to be in stock. So I don't own T-bills. I don't anticipate ever owning T-bills, but not that they're a bad investment. Again, they're the safest investment on earth. Okay, savings bonds. So these are bonds issued. These were really big during the war. These helped fund the war effort. And you would loan essentially the government money, and then they would give you a savings bond. Right now, they pay a total of 0%. In fact, they quit printing them. So if you have any savings bonds, it's time to take those down to the bank, cash them in, get your money, and start investing in that. It seems like my grandparents were really into savings bonds, and they'd give them to me for my birthdays every once in a while, and that was like a thing to do. But anyway, today it's just not a good investment vehicle. I would avoid savings bonds altogether. Okay. Well, what happens if I have my money with the bank and then the bank goes out of business and goes bankrupt? What happens to my money? Will I lose my money? Well, and this was a real legitimate threat. This happened, we've had a couple threats in the 20th century there at the beginning of the 1900s, we had a couple runs on the bank, and JP Morgan stepped in and brought in extra money and calmed the fears. And then in 29, during the stock market crash, we had a run on the banks. So what the government did is said, okay, well, if you're going to have a bank, you have to be able to ensure that the people are going to get their money. So they created this thing called the FDIC. Okay, so this is insurance on your money. So in other words, if you have $50,000 in that bank and the bank goes bankrupt, the Federal Insurance Corporation, right, they will come in and they will give you your $50,000 back. It has happened. It happened in 2008 during the crisis at a couple of them that the FDIC came in and took over the bank. And they took over the bank. It was like they do it quick too. So they took it over like on a Tuesday, and by Wednesday morning it was open under a different name and handing out money. Whenever they needed it, here you go, here's the extra money, because they don't want to have a run on the banks. So some people go, well, banks are insured, and so that's why I want to do my business with banks. That's foolish. Because while banks are insured, so are credit unions. They just have a different insurance company, but both of them are insured up to $250,000. So if your balances in that entire bank or credit union are under $250,000, you're guaranteed to have that money in the event that the bank or credit union goes bankrupt. Pretty rare, but it does happen. It has happened in my lifetime. It's happened in your lifetime as well. So just something to be aware of. Your money is safe with the banks or credit union. You don't have to worry about losing your money, right? Don't hide it in your mattress. That's what people used to do. Don't do that. But you just need to understand that the insurance is specific to each person, not the account. For instance, let me run through a scenario here. Now, I'm not a fan of banks. Chase Bank is probably the least worst bank, whatever that means. So I used to work for Chase Bank, by the way. Decent organization, but I'm just not a fan of banks. So anyway, okay. Let's say I have $150,000 in my checking account with Chase and $75,000 in my savings account, and I decide to purchase a CD for $100,000, right? So I've got all of this in my account that totals $325,000. I have exceeded the maximum insured amount. So only $250,000 will be insured. Doesn't matter if it's in separate accounts. So what I would do instead is I would take that CD and move it over to some other financial institution. That way I could get the insurance that way. Now, I will tell you this. I don't know of any time in the last probably 50, 60 years where a bank has gone out of business and the individuals have not been paid in full, even if your balance exceeds the insured amount. It used to be $100,000, then it went up to $250,000. The goal is to have the full faith of the public, and when you don't have the faith of the public, then they don't put the money in the banks. So anyway, so they've always covered them. You have a lot of business accounts that have millions of dollars in it. Yes, only the first $250,000 is insured, but the rest is safe as well. So I wouldn't worry about that as either. Okay, this changes subjects just a little bit, but I want to go through a couple of these. Good items. Shred all sensitive documents. So if you get a bank statement or you get an investment statement, don't throw it away. Shred it. You don't want that information getting into the wrong hands, okay? I get some weird emails from time to time. Here's an example of an email that I got. And it says, okay, click here. We can assist you. Your account has been put on hold. The problem with this is I don't do banking with Chase. This is a fraudulent email that I received. I have this one, and they'll do it, and they'll masquerade as something else. PayPal, I get them as PayPal. I get them as Amazon. I've gotten one. Just understand that they're not going to send you a link, have you click on that link, and then have you enter in your personal information. It won't happen. These companies don't do that. If you need to reset a password, they can click a button to reset a password, but they're not going to ask for your date of birth, social security number. Don't enter that information and don't fall for that. I get something like this sometimes too. I have a business proposal for you for $30 million. Or a prince in Nigeria needs to leave the country and needs to hide his $30 million in your account. Please give me your account information. Do not do that. All they're going to do is go into your account and steal all the money. I have a really good friend who did something similar. I had a similar scenario with that, where they promised to send them money as long as they bought some gift cards, and so they'd have to scratch off the gift card and then take a picture of it, and then they would send money. And anyway, they just got taken. Don't do that. They lost a lot of money there. Don't do that. There's an old saying, if it sounds too good to be true, it probably is, okay? And go by that saying. Don't deal with these emails. If it sounds fishy at all, just get rid of it. Okay, do not give out your personal information. If you don't know who that is, do not give it out. Okay, I had a student loan company call me once, and they called me on the phone and said, hey, I want to just verify it's you. Can we go through some information? What's your date of birth? And I said, I'm not giving that to you. I don't know who you are. You're claiming you're from somewhere. I'm not giving that to you. I said, why don't you give me what information, who I need to talk to. When I get home, I will look up what your phone number is and I will call you. And then I can provide that information. But there's no way I'm just going to let some random person who calls me claiming to be someone, that I'm going to give them my date of birth and social security number. No way. So just be aware of that. Don't respond to fishy emails. That's like the one that we just talked about. Do not carry your social security card with you. The only time you should have your social security card on your person is whenever you're finishing the application for a job and they need a social security card to verify that you are legally allowed to work in the United States. So do not write your PIN on your debit card, please. Do not share that information. Do not take pictures of your credit card and post them online. I know you may be proud that you've got your new debit card. Don't show it off. That's got sensitive information. Someone will steal that, so just avoid that, okay? Okay, if you lose your debit card, I want to go through just a couple things with you on if you do lose it, here's what you should do. Number one is report it immediately. Just call your bank or credit union and say, hey, I lost my card. They'll say, when did you lose it? And say, I don't know, I just realized it now that I lost it. And they say, okay, no problem. Here's what your penalty is. If you notify them within 2 days of you discovering that you've lost it, you only have to pay $50. That's it. Even if someone comes in and cleans out your account, your bank or credit union will replace that money. You're only responsible for that $50. And if you wait longer than 2 days, but less than 60 days, $500 is the maximum. So the big thing is as soon as you identify that it's missing, call and cancel it. They'll issue you a new card. It doesn't cost any money to do so. I have had it happen where I called them and money was taken out of my account and they just paid 100%. Now, I do business with the credit union, so they're a little bit nicer and a little more customer-centric, but they didn't charge me a dime. They just replaced the money, and then they went after the person who stole my debit card. So anyway, not that big of a deal. Just tell them right away is the big thing. If you wait longer than 60 days, then you're responsible for everything. I don't know who waits that long and have all that money missing. No way. Just check it periodically, and you'll be okay, all right? Okay, overdrafts. This is when you write a check for more money than you have in your account. Okay, because you can write a check for any amount. So let's say you write a check for $800. Well, you only have $200 in your account, so that's going to come back at you. So you've written it for more money that's in your account. They're going to charge you a fee. Outrageous. So do not spend more than you have in your account. Make sure you've got enough money in there, okay? Stop payment. Now, this is possible on a check. If you were to write a check and you lose the check, well, you don't want the check just floating out there. So what you do instead is you issue a stop payment on that check. So let's say that you write a check for $800 to pay for your rent, and you send it to your landlord, and then your landlord calls you on the 5th and says, listen, I haven't received your rent yet. And you say, whoa, I sent it 10 days ago. Okay, well, you're like, well, I'll cut you a new check for $800, but I don't want you to cash the old check. So then what you'll do is you go to your bank and you issue a stop payment, meaning whenever anyone tries to turn in that previous check for $800 and get money out of it, it will not issue any money on that check. Okay, it usually costs about $20 to $25. It is possible on all checks. Now, the reason why that's important to know is because when you're transacting business, maybe you're selling something through Craigslist or OfferUp or something like that, do not accept a check, because anyone can issue a stop payment. So if you're selling your computer and the person comes in and says, okay, here's a check for $900. And you're like, okay, that's great, thank you. There's no guarantee that check is worth the $900, because I could have a closed account that I closed 3 years ago and still have a check that I can write you for $900, and it will not cash. So whenever you do business with someone that you do not know, 100% of the time you do business in cash. Do not, even on a cashier's check, we'll talk about that in a little bit, you do not receive a cashier's check, cash, or go to their bank, right? And their bank can give you the money. So just be aware of that. Here's our special types of checks. Money order. This is essentially a glorified check that money comes out of your account immediately. So let's say I wanted a money order to pay for that laptop. I could go to my bank, get a money order. They would take the $900 out of my account and give me the money order. Then I could give you the money order. Here's the problem with money orders. They can be canceled. They can have a stop payment issued on a money order. So even though the money has come out of my account, I can issue a stop payment on it, wait 2 weeks, and get the money back. I have done it. I have lost a cashier's check before, and that's the next one. A cashier's check is basically a money order that's larger, right? You can get it for $20,000, $30,000. Maybe if you're doing a down payment on a house or something. I've done it before where I lost a cashier's check, and I couldn't find it anywhere. And so we ended up issuing a stop payment. Cost us about $25. And they waited about 2 weeks and then put the money back in our account. And then I got another cashier's check and gave it to them. So just be aware that cashier's checks can be canceled and stopped. So don't fall victim to that, okay? If you don't know the person, you are dealing with cash, or you go to their bank or your bank. It doesn't matter which one, but some other professional financial institution, okay? All right. Here are my recommendations. Number one, pay yourself first. When you get your paycheck, you want to set aside 10% into your account, and you can do that directly, right out of your check. That's the way I have mine set up. A very specific amount comes out of my paycheck and goes right into my investment accounts every single time I'm paid. So I never even see the money, goes right to my investments. I can live on the rest, and my investments can grow. That's what I recommend, at least 10% for your retirement. Okay, pay yourself first, and then create an emergency fund. An emergency fund is the most important thing you will learn in this class. Save the money. In the event that something happens, you've got money to draw on, okay? All right, well, this will complete this section on banks and credit unions. Please let me know if you have any questions, and I hope you enjoyed.